Morning guys, Joel Frank here, market analyst for YouTrading, and this is the midweek market update. So let's jump straight into it, starting by looking at the performance of US equities. So I've got here the S&P 500. This is a cash CFD, so it kind of tracks a mixture between the futures and the cash index when US equity markets are actually open. But anyway, as you can see, I've got it on daily candlesticks here. It's been a solid performance so far this week. 5 straight days of gains when we closed yesterday. Trading slightly in the red this morning, as you can see, before the market opened. But still, we're hanging out very close to recent highs. And you can see we're only... I mean, at these levels, we're only about 0.5% off the record highs that were set back here at the start of September. So things have been very, very bullish. Earnings optimism has been the major thing behind this move higher, really. And it started off with the bank earnings, very, very good. We've got a lot of high-profile tech and growth stocks reporting earnings this week. Okay, so we had Netflix last night. That was very good. All the user metrics pointing higher, helped out by obviously Squid Games has been very popular. It's been the most popular series Netflix have ever made. We've got Tesla earnings tonight, and then we've got more big tech names out in the next couple of weeks. So yeah, really, are we going to challenge these record highs? It's going to come down to whether the rest of the earnings season is as strong as what we've seen so far. And if it is, then I think this index has surely got to be in for fresh record highs. You can see we've already gone past all of the major fib retracement levels, gone past the 50. See, if the 50 for a bit, the 50% retracement was pretty good resistance, but smashed through that, then smashed through the 61.8, and then yesterday the 76.4. So not really any technical resistance now for the record high. Moving on. Bond yields have been moving higher amid the recovery in risk appetite that we've been seeing in stock markets. We have been seeing in recent days. This is a daily chart of the T-note cash, and that's been moving lower in recent days. The yield is actually this morning managed to hit multi-month highs. Not quite in the cash index here, but it seems likely that as long as risk appetite in the equity markets continues, then we should continue to see these bond prices moving lower. And that probably means there's going to be a break below this resistance here from back that was late May and early to mid-June. And then obviously we bounced there in early October. So we should probably see that level go. More specifically to bond market fundamentals, money market pricing for the Fed's rate hiking cycle has been getting more hawkish and more aggressive, and it continues to do so this morning. I think I saw the CME FedWatch tool had a near 50% probability that the Fed are going to hike interest rates as soon as June next year. June, that is very, very soon. And as long as markets continue to view this Fed tightening cycle as not a policy mistake, as the optimal policy response to inflation in order to maintain long-term economic growth, well then long-term bond yields should continue to move higher, and then long-term bond prices should continue to move lower. It's where markets start worrying that maybe this is a mistake, the Fed's going to hike too quickly, then they're going to have to cut rates. That's when you could see longer-term bond prices actually doing quite well and yields falling. And then obviously in that case, you would see us potentially bouncing. But there's no signs really of concerns about a Fed mistake being too hawkish just yet. Moving on, this is all relevant for the dollar as well. Risk appetite has been weighing on the dollar just like it's been weighing on bonds. And the dollar has fallen back, as you can see. And it's testing, well, it's bounced at 93.50, but it's kind of testing this support from back on the 23rd of August. Consolidating around there for the time being. Dollar had been performing very well in the last couple of months, as you can see. All the way from May, we'd been moving higher. And there were some concerns that positioning had got a little bit too aggressive in terms of people being bullish. So profit taking has been cited as one reason for the recent drop in the Dixie. Most people, or most FX strategists at least, think that the dollar is going to remain a buy on dips. So probably seems likely we're going to be testing these highs again within the next couple of weeks. I mean, if risk appetite is really, really amazing, then maybe we might be in for slightly more range bound conditions. Maybe we could eventually even test these lows down here around 92, the lows from September. But we're going to have to see. Finally, crude oil markets. Not really much to update on, to be honest. Like, ever since we had that big break above this key area of resistance, the multi-year resistance, which was around 77. We hit it in July, and that was the high from all the way back in 2018. We've been edging higher. WTI a little bit lower today, actually. There's been some indications that the Chinese authorities are going to act to make sure that the spike in coal prices there, because coal prices have been shooting up recently in China, doesn't get too out of hand. Obviously, fossil fuels, they're correlated with each other, so that has taken some of the wind out of crude oil, which is why it's pretty much flat on the week, isn't it? But still continues to trade close to recent highs, because when it comes down to it, energy markets are tight. Crude oil markets, you've got OPEC still restricting output, and as a result, global crude oil inventories are falling. Natural gas, obviously, we know the situation there. There's potentially going to be a crisis this winter if things get too cold. And obviously that affects coal as well, because coal is heavily used in emerging currencies for heating purposes as well. But zooming out of crude oil markets, if you're bullish still, which I think a lot of people are, then you still eventually want to look, we have to zoom out and go really far back, for a test of these key levels here, which are above $90 per barrel. One note of caution before you just jump into long positions. A lot of technicians, mainly, have been warning that conditions are getting a bit overbought in crude oil. So what might be optimal is waiting for a bit of a pullback, perhaps to this 21 DMA, just under 78, perhaps a little bit lower to this that previous level of resistance. Maybe that could act as support. That might be the better opportunity to get in. Although that is quite a big decline, to be honest, from current levels. So maybe people would be eager to buy the dip before we get to that point. But anyway, things are looking a little bit overbought. So maybe look for crude oil to consolidate a little bit before pushing higher again. But yeah, guys, hope you enjoyed the video, and I'll see you all in the next one.